Good evening, everyone, and welcome. Well, if you'd gotten used to relatively modest stock market moves this year, this week has delivered quite a jolt. Call it a double dose of Red Bull if you want, or maybe not. The Bulls were not in charge today. The Bears were. And technology and financial services shares led the major market barometers down. It was their worst day collectively since late July, and the fourth day in a row of triple-digit moves for the Dow, 3 of them downward dogs. Worries about global growth, geopolitical tensions, and some soggy economic data set the tone. Orders for so-called durable goods tumbled more than 18% in August, biggest monthly decline ever. That's mostly on a demand pullback for new aircraft. Also, first-time jobless claims rose 12,000 last week, even though they're still sitting near 7-year lows. All 30 Dow stocks ended lower as the index dipped 264 points, closing back below 17,000. The tech-heavy NASDAQ down 88, nearly 2%, and the S&P 500 dropped 32. Bonds rallied as investors took cover in treasuries. Yields on the 10-year fell to a 2-week low. Bob Pisani now with a look at today's drop and why big moves are suddenly back on Wall Street.
It was the fourth day of triple-digit moves in the Dow. Slowing growth around the world was an issue for the markets earlier in the week, but today a couple of additional issues surfaced. First, Richard Fisher, the head of the Dallas Fed, said before the markets opened that the Fed may start raising rates in the spring of 2015. That's earlier than most expected. Now, Mr. Fisher is a hawk. He's made similar comments before. But traders are well aware that the markets have struggled when the Fed ended its stimulus program in prior years. Mr. Fisher took particular aim at high-yield markets, saying he was seeing extreme risk-taking. Not surprisingly, high-yield exchange-traded funds dropped, some of them over 0.5%. That's a big decline for bond funds on very heavy volume. Second, there were vague reports that the Russian government may enact a law to seize foreign assets on Russian territory, likely in response to Western sanctions. Why is this important? Because Europe is already in a period of no growth despite keeping rates low. Any further escalation of that conflict could throw Europe back into a recession. That's a problem. The German market weakened when that story first came out prior to the U.S. Open and ended down 1.6%. From there, it was risk off in the U.S. markets. Emerging market ETFs were down over 2%. Momentum stocks that are heavily traded, like biotech and solar stocks, were also down 2 or 3%. While volume at the New York Stock Exchange was not particularly strong, there was heavy volume in the futures markets, suggesting that there were a few large sellers today. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.